On your marks, get set, invest. Welcome to episode number 10. If you've got this far, then you now understand more about investing than 99% of investors. Okay, I don't know if it's 99%, but believe me, I've worked with and helped a lot of investors, and I see the same simple mistakes being made time and time again, which costs them large chunks of their gains, and sometimes even leads to financial disaster. We've outlined lots of the major pitfalls and shown you how to invest in a sensible, sustainable way. So let's rewind and remind ourselves of the key lessons. Get these firmly in your mind and you'll be in peak condition, fighting fit, and ready to invest like the best. First, we talked about how people invest in all sorts of things: shares, bonds, property, gold, silver, cryptocurrencies, stamps, wine, classic cars, art. These are all assets, things that have value, and each is a different asset class. Remember, cash is also an asset class. In this course, we've just focused on shares and funds. When you buy a share, you're buying a piece of a company. And sometimes you'll get a share of the company's profits, known as a dividend. People buy and sell these shares on the stock market. Then, we talked in episode 2 about the miracle of compounding. Behold! Compounding is the miracle that turns small amounts of money into large amounts of money over time. Say you invest £5,000 in shares and they rise in value by 10% per year. 10 years later, you'll have about £13,000 invested. Another 10 years later, you'll have £33,500. And another 10 years later, you will have more than £87,000. Notice that we haven't actually added any more money to the investment since that initial £5,000. And the gain each year is always 10%, and yet your total investment value rises faster and faster and faster. That is the miracle of compounding. 10% of not much is not much more, but 10% of a lot is a lot more. Compounding works best over long periods of time, so the earlier you start, the better. Also, it means you don't have to make massive annual profits in order to build up a big nest egg. Slow and steady is the way. Now, remember the social media show-offs who make huge profits quickly, but in order to do that, they have to take huge risks, which means they usually blow up their investment accounts sooner or later? Remember them. Also, another tip for successful compounding is to invest using a tax-free account. ISA stocks and shares accounts allow you to take your investment profits without paying any tax on them. Instead of buying shares, you can invest in funds that buy a whole bunch of shares in different companies at the same time. This saves you time, of course, but it also allows you to benefit from diversification, which means spreading your risk around different investments so you're not too exposed to the risk of any one company's share failing. When you buy a fund, your profit is reduced by the significant fees you have to pay, because fund managers don't pick shares for you for free. So these are mainly so-called active funds. Passive funds, meanwhile, are those where a fund manager has a more hands-off approach, often mechanically buying every share in an index. An index, such as the FTSE 100, is a way of tracking the price performance of many different shares. In the case of the FTSE 100, it's tracking the share performance of 100 of the biggest companies listed on the UK stock market. So when you buy a passive fund tracking the FTSE 100, the fund automatically buys whatever shares are in the FTSE 100. So the fund manager doesn't have much work to do, and so the fees tend to be low. Funds, like shares, can be very risky with wild price swings up and down, or they can be much more sedate. Some people, like this cautious character here, require low-risk investments, either because they'd be too worried about taking more risk, or because their circumstances in life require a more cautious approach. They might not be in a position to earn money in the future, perhaps through age or illness, and so they need to make sure that they don't take on much risk of losing money. Many other people, though, are willing to take on a moderate amount of risk. They're willing to put up with some ups and downs in their portfolio value in the hope of getting bigger returns. And then there are the real risk takers, the high-risk investors. They are willing to take the risk of losing a big chunk of their investment in order to be in with a chance of having some big wins. Low-risk investors typically keep a lot of their money in cash in the bank. The problem is, in some years, this can't really be considered exactly risk-free because of inflation. Inflation refers to the speed at which prices go up in the shops. So say inflation is rising at 3% per year, but your cash in the bank is growing at only 1% per year. That means that prices are rising faster than your savings are. So your savings aren't going to buy as much stuff as they could have done the previous year. That is why inflation sucks. And that's also why even low risk is on the lookout for investments that might provide a bigger annual return. One notch up the risk-reward scale is government bonds. This is when you lend money to a government and they promise to pay you back with interest. Major governments don't really offer much interest because they don't need to, as people are willing to trust that they'll pay back their loan in full. But usually they'd at least offer more interest than you'd get on cash in a bank savings account. Now, corporate bonds are a little bit more risky. With these, you're lending money to big companies. The chance of a big corporation becoming too broke to pay back the loan is not high, but it's significant enough that they usually have to offer more interest to investors than governments do. So, low-risk investors often buy bond funds through their investment platform and sometimes some low-risk shares or funds. Medium-risk investors, meanwhile, will usually invest more of their cash in shares and stock market funds than in bond funds. High-risk investors buy high-risk shares, and they also buy high-risk funds. But don't forget that low-risk investors can sometimes put a bit of their money into high-risk investments, and high-risk investors can put some money into cash and government bonds. The important thing is that their overall portfolio suits their preferred risk level. So even if a low-risk investor buys a high-risk share and it goes badly wrong, the loss is still only a small chunk of their overall portfolio. So the big piece of advice for all these types of investor is do your research. Don't just listen to tipsters, even if they're your own family or they really seem to know what they're talking about. You need to thoroughly understand what you are about to invest in. You can look at the revenues and profits of a company, in other words, how much the company is making from selling things and how much they've got left over after they've paid for rent, wages, expenses, etc. It's also important to check how much debt the company has and whether it can easily afford to pay the interest on that debt or not. And you can also read the company's latest financial results document, which will tell you a lot about how the company's doing and what its future plans are. The CEO's Outlook section is often particularly enlightening. You will also want to find out the outlook, though, for the wider industry sector that your company is in. For example, you might want to read articles about what headwinds are currently blowing around that industry. And if you're looking at a fund, you can go to the website of the company that runs that fund and find all the information the company provides, including the top 10 holdings inside the fund and the fees that the fund managers charge. For more in-depth valuations of shares, you can use the price-earnings ratio, PEG ratio, price-book ratio, and dividend yield. We talked about those in episode 4. Now, if you have trouble getting your head around the ratios, the most important thing is just to try and understand what the company actually does and how it makes its money. Then we looked at market timing. Should you try to buy at particular times, like just after a market crash when prices are relatively low? Or should you accept the old market wisdom that there's no point trying to time the market because you can't know the future, so you'll probably just get the timing wrong? Really, this is a decision for each individual, and you may wish to experiment with different approaches. You could just stick all your money into the market straight away, or you could invest using pound cost averaging, meaning that you filter in your money slowly over time in the hope that the times that you buy at high prices will be balanced out by the times you buy at low prices. We also cautioned against succumbing to FOMO, the fear of missing out. This is the desperate urge that many of us naturally suffer from to pour our money into the latest fad or craze because we keep reading stories about people who made $1 million overnight. Inevitably, most people invest far too late after all the easy money has been made and just before the whole house of cards collapses. So please beware of FOMO. Another method of deciding when to buy a share or a fund on a stock exchange is to look at the price chart and learn how to spot trends. Established trends have a tendency to persist far longer than would be the case if price movements were random. So in other words, if you buy a share that's doing this, there's a pretty good chance it will end up doing this. Whereas if you buy a share that's doing this, there's a pretty good chance it'll end up doing this. Now, there are other tools that you can use too, including moving averages and the volume of trading activity. All of these things will help you decide when to buy. In episode 7, we tackled the tricky but crucial topic of when to sell. When an investment's not heading in the right direction fast enough for your liking, you need to ask yourself why you invested in the first place and whether those reasons still apply. Would you buy it now if you didn't own it? And if not, why not? If the price is refusing to budge for years on end, you need to ask yourself whether you're happy just to receive the regular dividend payments or whether perhaps you could do better. Remember, every investment has an opportunity cost, which is the best alternative investment that you could be putting that same money into instead. Many people have difficulty selling lackluster investments. When we've put a lot of time, money, and effort into researching and investing in something, we can get quite attached to it, even if it turns out to disappoint us. It's really hard to admit to ourselves that it's a failure, particularly if we've actually lost money on it, because then we start hoping it will rise again, and we're hoping that will plug the hole in our self-esteem. One of the biggest mistakes that investors make is holding on to losing investments until the losses become so huge that they devastate their portfolio. Admitting that to yourself earlier rather than later can save you a lot of financial and emotional heartache further down the line. Now, when an investment is doing really well, many experienced investors choose to sell part of it to rebalance their portfolio. Because if one share or fund does particularly well and achieves a high value, it can quickly start to dominate your portfolio, which meant that if it crashed, your portfolio might take a big dent. By selling part of it and using that money to invest in something else, they prevent any one investment from becoming too crucial to the future success or failure of their portfolio. In episode 8, we looked at how to open an investment account, first making sure that it's registered with the Financial Conduct Authority. Then we looked at buy and sell prices, sometimes known as bid and offer or bid and ask prices. The difference between the two is known as the spread. We also looked at all your rights and obligations as a company shareholder and the various corporate actions that you may need to respond to, such as a takeover offer for your company. And finally, in episode 9, we looked at how to discover great investments in the first place, looking through reputable news sources, financial websites, and fund platforms to get ideas. You now have the main tools that you need to start investing, and you're aware of the major pitfalls. So you won't have to do so much of that costly trial and error that I did rather a lot of when I first started out on my investing journey. And if you're investing via an independent financial advisor, then this course will have armed you with all the relevant questions to find out exactly what they're planning to do with your money, and don't be afraid to question their wisdom. Now, if you're going to invest directly yourself, here's a handy checklist for you. First, search for promising investments using the kinds of reputable sources we looked at in episode 9. Second, once an investment has caught your eye, supercharge your research by looking through the financial results and any available analyst reports. For shares, check out the financial ratios, such as the price-earnings ratio. These can usually be found on the website of the stock exchange where that company is listed. For funds, there's always plenty of in-depth information on the fund provider's own website and your investment platform site, as well as on independent sites too. Next, take a look at the price chart. Is it heading up, down, or sideways? And how volatile are the movements along the way? Will it be a bumpy ride? How risky does the investment look? Does it fit in nicely with the rest of your portfolio, giving you the kind of mix of risks that you're looking for? And then you need to ask yourself when to buy. Do you want to put your money in slowly through pound cost averaging, or put in all of it at once? Do you want to wait for the price to start moving in a more positive direction before you take the plunge? Once you've invested, you need to regularly monitor your investments. You don't want to neglect them, but neither do you want to sort of obsessively check them all the time, as that way lies madness. Take it from me. If you're taking a very long-term view on your investments, then you could consider checking them only once a month, perhaps even less often. But if you're hoping to be a more active manager of your money, then weekly or possibly even daily checks would make sense. You should ask yourself, does anything need selling? Does the portfolio need rebalancing? Has your personal situation changed? And does that affect how quickly you might need returns on your investments? In other words, has your investing time frame changed? Do you want to reinvest some dividends for greater compounded returns? If you do all of that, you will be streets ahead of the average investor. You will have a lot more control over your future. Much better than burying your head in the sand, I'm sure you'll agree. So now you are ready. On your marks, get set, invest.